Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures wavering to some degree after the S&P 500 closed out yet another record high. Meanwhile, investors are watching the latest read on the economy with retail sales data. The July numbers did show a broad-based advance in consumer spending. 9 out of 13 categories posted increases, led by the biggest gain in motor vehicle sales since March. Plus, investors monitoring geopolitical risk in the market. President Trump and Russian President Vladimir Putin are meeting in Alaska later today. The leaders will discuss plans to end the war in Ukraine. Assets to watch: European infrastructure and defense stocks, commodities, including oil and natural gas, and currencies like the euro. And Warren Buffett buying up shares of UnitedHealth. Shares are jumping after Berkshire Hathaway disclosed the purchase in its latest 13F filing. Berkshire bought around 5 million shares of the beaten-down stock. That brings Buffett's stake to $1.6 billion. UnitedHealth has faced unexpected increases in medical costs, and its share price plunged after it missed earnings estimates. It's since replaced its CEO and announced plans to replace its CFO. Let's get a check-in on stock futures here. We have little change here this morning, particularly when you're looking at the S&P and the NASDAQ, which is pointing to a slightly lower open, the S&P indicating a slightly higher open, and the Dow gaining the most today. That's because UnitedHealth is in the Dow and it's price-weighted average, and so we are seeing it outperform the other major averages in terms of where futures are pointing this morning. Let's dig into our top stories of the day. Wall Street headed for a winning week ahead of the Fed's Jackson Hole Summit, plus retail sales data giving insight into the state of the consumer. And President Trump and Russian President Vladimir Putin said to meet in Alaska today to discuss ending the war in Ukraine. Joining me now, senior reporter Ali Canal live from the NASDAQ, and Ramzan Karmali live from our London studios. Ali, I'll start with you and that retail sales number, which I'm afraid doesn't make anything easier for the Fed, right? Sort of makes things murkier in terms of the economic picture.
Right. It came in broadly stable, roughly in line with estimates, the second straight month that we've seen this uptick. We also saw May and June's numbers revised higher. So that shows the consumer is still spending. I'm looking at my inbox right now, Capital Economics out with the reaction, saying that this report shows households continue to spend in healthy amounts despite the threat of tariffs, especially given the increase in sales in areas which have experienced tariff-induced price pressures recently. And if we take a look under the hood at some of the categories that saw the biggest gains, we saw furniture up 1.4%, recreational commodity stores up 0.8%, cars and parts up 1.6%, and that was on the back of greater incentives that we saw last month as well. So seeing a lot of that resiliency. That being said, there were some signs of caution. For example, restaurants and bar sales that declined by 0.4%. We also saw electronic sales fall. Now that may reflect some of those tariff-induced pricing pressures, but overall we are seeing this resilient consumer, and that is key for the Fed, a consumer that continues to spend, but they're only going to continue to spend if they have a job. So that circles back to the labor side of the equation. That's why that is so important when it comes to the Fed's dual mandate. Of course, earlier this week we saw that hotter than expected PPI print coming in at a 3-year high. That complicates things for the Fed as it moves forward, because they want to make sure that they have the labor market that is so solid that it can continue to support that consumer, but they don't want inflation to run away. So like you were saying, it really does not help the Fed when it comes to their decision next month.
Well, and before next month, of course, we're going to be hearing from Jay Powell and other Fed officials at the Jackson Hole Economic Symposium next week. What are you seeing in terms of commentary about what people are watching or how they're setting up going into that meeting?
Analyst Michael Hartnett at Bank of America, he said that it's possible we could see a buy the rumor, sell the fact at Jackson Hole if Jerome Powell comes out and is a bit more dovish and really aligns with that consensus that we're seeing from markets. We are at about 95% odds, according to the latest CME Fed Watch tool, when it comes to seeing that 25 basis point cut in September. And this is despite the fact that we've seen those hotter inflation prints. So overall, markets are still convinced that we're going to be seeing that rate cut in September. Looking out to the end of the year, they're pricing in about 2 to 3 total cuts. So if Jerome Powell comes out and basically aligns with what markets are thinking, we could see some profit taking. However, if he comes out and he's a little bit more cautious, I would expect to see some volatility and maybe a recalibration of those odds. So a lot is riding on Jackson Hole. It's usually a pretty volatile month, and September in general usually has some choppiness in the market. And I have been hearing from analysts that I speak with, sources that I talk to, that September, October, heading into the fall months, especially as we see more data come in, that could maybe lead to a downward correction in stocks, considering the record highs that we're currently trading at right now. But we'll have to wait and see. I do think that's going to be a big catalyst, though, for markets looking ahead.
And speaking of big catalysts and speaking of things where a lot is riding on it, high stakes. That's what President Trump posted on Truth Social, right, about his meeting with Vladimir Putin in Alaska later today. This is going to be the first meeting of the two leaders, especially on American soil, since Russia's invasion of Ukraine. And Ramzan, obviously traders here in the U.S. are watching this very closely, but probably no one is watching this meeting more closely than European leaders and European market participants, because indeed the stakes are high and there are a lot of implications here. So what's on your mind? What's on the mind of folks that you're talking to about all of this?
Well, European markets have been very interesting this morning. In early trade, they rose quite dramatically. They pared back a bit of those losses, and since the retail sales number came back out, they've gone up again a little bit. The FTSE there, the big laggard, the FTSE hit an all-time high, helped by mining stocks like Glencore, which was actually still up around 3%, but slipped back from its record high. Perhaps a bit of profit-taking there going on in London at the moment. But, you know, that sense of optimism, seems to be a sense of optimism surrounding these talks, and some of the stock movements that we've seen reflect this. I mean, take European defence stocks, for example. They were trading higher throughout this year. One in particular that really sticks out for me is Rheinmetall, the German's arms manufacturer. It was up over 150% this year to date. But today it's down over 2%. And in fact, over the last week, it's down 10%. Now, the dramatic rise in defence stocks mainly down to the fact that most NATO countries agreed earlier in the year to increase their spending to 5% of GDP. But then now we're seeing interesting moves in infrastructure firms. Firms like Siemens Energy and Schneider Electric, they could be seen as benefiting and being in a prime position to perhaps rebuild Ukraine after the war.
Right, so a lot of sort of very concrete ramifications there. Also, I know, Ramzan, you're watching commodities. You know, we've seen gold sort of a background beneficiary of this, you know, geopolitical risk that has been persisting here. So that's one that I know traders are watching closely as well.
Yeah, gold is up around 25% this year. In fact, it's up. It's doubled, in fact, since 2022. It's not the only commodity that's benefiting as well. There's a lot of eyes on copper as well, too. And, you know, copper is used in a lot of manufacturing that we do in Europe too. So that's another one to watch too. Oil as well. We could see oil prices push lower, in fact, if there is some sort of breakthrough in these talks. Remember, the US is angry with India and China, for instance, for buying Russian oil. There's also sanctions on Russian gas as well at the moment. So I wouldn't expect any sanctions to be lifted off Russian gas and oil straight away, but there could be some movement here which could see crude oil sort of trading lower. They're currently trading near a 2-month low right now.
And Ali, you know, obviously there are these sort of specific assets, specific stocks where we could see an impact here. But overall, stocks here in the U.S. have been remarkably resilient in the face of various geopolitical headlines.
Yeah, markets are really looking through a lot of these risks. And even when it comes to inflation, it feels like markets seem to be ignoring some of those concerns, at least in the short term. There has been some talk on Wall Street that perhaps right now markets have really priced in that over the near term, we're going to continue to see inflation. Geopolitics, of course, the risk there, it's always lurking around the corner. You can just look at earlier this summer with the Israel-Iran conflict and the war that escalated there. We saw oil prices spike, and we know what that did to equity commodities as well. So that doesn't mean the risk isn't present. However, it just feels like there's so much momentum in this market. There's been a lot of optimism over risk assets. Crypto has surged. Big tech continues to lead, and really earnings have been incredibly strong. And that's leading to estimate raises across the board on Wall Street, not just for the rest of 2025, but also 2026 and beyond. And that really seems to be what the markets are focused on, what analysts and forecasters are focused on, and looking through a lot of these wider geopolitical risks as essentially noise, really focused on those fundamentals at this point.
Ali, Ramzan, thank you so much. Appreciate it. UnitedHealth shares are soaring after Warren Buffett's Berkshire Hathaway revealed a new stake in the insurer. Yahoo Finance senior health reporter Anjali Kamlani here now with a closer look at that investment. It's an interesting one.
Yeah, it certainly is. We know that 5 million shares have been purchased of United Healthcare stock by Berkshire Hathaway, and that is coming at a time when the stock is at quite a low. We know that it was, quite on quite a run for the last few years, and then started paring back and down 46% year to date as of yesterday's close. But it is shooting up today as a result of this investment, and the reason being that we have a lot of different changes that have happened at the company. While it's under pressure from macro factors in the industry, such as cost of expenses, the medical expenses are on the rise. They've seen the tragedy of a executive shooting late last year, as well as the cyber attack that happened earlier in the year. So it's just been compounding problems for the healthcare giant. And now we're seeing a switch in the CEO, Andrew Whitty stepping down, and then returning CEO Stephen Hemsley at the helm. He also, by the way, was at the helm when Berkshire last had a stake in the company. That was back in the 2006 to 2017 period. In between there is when Berkshire did let go of its shares before previously had about 1 point something million. So looking at that, it might indicate, Berkshire's and Warren Buffett's interest in Stephen Hemsley being back. We do know that with all of these problems, the company has indicated that they know that there is a turnaround needed, that they are under pressure, a lot of it. Hemsley did say on a second quarter earnings call back in July that, the company has made mistakes, quote, saying that beyond the environmental factors, just I told you about those macro factors in the industry that are reflecting impacting the entire sector, and more specifically to them, they've made pricing and operation mistakes, as well as other companies. Of course, we've seen many of their peers under pressure as well in the last year. They've missed earnings as well. So really all eyes on what this turnaround does look like and whether or not Berkshire came in at the right time before they start regaining some of that momentum.
Anjali, thank you very much. Great look at what has happened at this company. Appreciate it. Coming up, we'll bring you the other names Warren Buffett bought last quarter and push ahead to Jackson Hole as central bankers descend on Wyoming. We'll be right back. Now time for some of today's top trending tickers. We are watching Applied Materials, Home Builders, and Nubank. First up, Applied Materials. Those shares are sinking as China weighs on its forecast. The largest American producer of chip-making gear plunged after giving a disappointing sales and profit outlook. The company seeing weakness from customers in China. Its CEO also said large customers are putting off some purchases in the face of tariff negotiations and other economic issues. Next up, we've got home builders D.R. Horton and Lennar. Those companies jumping after Warren Buffett's Berkshire Hathaway added to its stakes in the companies. The Lennar investment was worth nearly $800 million. The D.R. Horton stake was much smaller, worth as much as $191 million. And finally, Nubank shares soaring. Latin America's biggest digital bank said its clients' credit quality was holding up, and it expects credit growth to continue for the rest of the year. Nubank shares are up roughly 15% this year through Thursday's close after gaining 24% last year. The stock's been recovering since February when the fintech company shed $12 billion in market value after fourth quarter results fell short of expectations. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Well, central bankers will descend on Jackson Hole, Wyoming next week for the Kansas City Fed's annual Economic Symposium. Investors will be closely watching for any clues on the Fed's rate path, with investors currently pricing in cuts for September. Joining us now, Chris Versace, Tematica Research Chief Investment Officer. Chris, it's good to see you. Thanks for joining us. So when you look ahead to Jackson Hole here, really we have seen those rate cuts be priced in, but there still is an enormous amount of debate around what the Fed is going to do. What are you looking for? What will you be zeroing in on?
Well, I think everybody was kind of taken aback by the July PPI data. You know, whether headline core, whether it's year over year or on a sequential basis, those figures were a lot warmer than anybody was looking for. But I will share this, Julie. You know, we are going to be paying close attention to what Powell has to say during his keynote address next Friday, assuming he says anything. Remember, he doesn't have to. It's not really a monetary policy event. It's an economic symposium. But I think what we have to pay attention to ahead of Powell speaking next Friday is going to be the flash August PMI report from S&P Global that comes out the day before. That's going to kind of give us a little indication as to the speed of the economy during August. Inflation pressures, have they continued or accelerated? And then, of course, everybody's focusing on the jobs market. So what does that report say about manufacturing job creation, service sector job creation in the month of August? That to me is going to, you know, to the extent Powell says anything, the combination of the PPI report, the core July CPI report, and that flash PMI report will dictate what he says.
Well, and meanwhile, we got retail sales this morning that showed some strength, showed some areas of weakness, broadly sort of in line, I guess. It was sort of a mixed bag. I was also struck by import prices for July coming in hotter than had been estimated. So, you know, how are you thinking about consumer spending and the outlook for inflation when you put all of this together?
So a couple things. You know, I think when we look at the retail sales report for July, you know, folks are looking at that 3.7% figure that came in. I'm sitting back going, wow, if we strip out non-store sales, which of course benefited from Amazon's Prime Day, which was 5 days this year, as well as the competing efforts, it says to me that, you know, those numbers on a sequential basis, again, that category, were probably a little weaker than expected across the board. And that kind of fits with the narrative of the consumers, you know, trading down, you know, being more selective in their spending. So, you know, to me, I think the other thing we have to think about is also whether or not the August retail sales number will decline even further, given the likelihood for a pull forward in back to school spending, given all those digital shopping events. So I still remain a little concerned about the consumer, seeing them bifurcated, trading down where they can and, you know, spending where they want to. If we think about the comments that we've heard from airline companies about the back half of the year.
Yeah, and we also saw fares tick up last month, so that tells you something as well. And then, you know, put together with the retail sales numbers today, we've got the retailers, the big retailers, starting to come out next week. You know, we've already had, to your point, some of the restaurant fast casual come in weak, right? Chipotle, Cava, for example. So where are people spending their money in terms of, you know, we saw the restaurant sales in this retail sales report actually lower, but what are we going to hear from the big box guys?
So I think the cool thing about the July retail sales report is, you know, all the way over on the left-hand side of one of the big tables, they tell you what retail sales were for the quarter on a year-over-year basis, right? So we have a very nice yardstick by which to measure all of these companies that are reporting next week. But from my perspective, I think where we're seeing folks shop are going to be at the Costco's. Remember, Costco's July revenue report, adjusted US, simply stellar. I think others like a TJX or Ross stores will benefit as people, again, are looking to stretch their disposable spending dollars. To me, companies like, you know, Target, I think, you know, I've said this before, I'll say it again, I think they're lost. You know, they're trapped between where people want to spend and where people are cutting back. It's just going to be very difficult for them.
Chris, do you think investors should be in retailers? Do you think they should be in selective retailers, or is it just a sector to avoid right now?
I think select retailers, because folks are going to spend. You just have to capture where that spending is unfolding. And, if we're not eating out as much, like you just talked about, if people are concerned about, higher prices, they're going to trade down. And again, that's why, at least in the pro portfolio at the street, we're very comfortable owning companies like TJX and Costco.
And what about kind of elsewhere where you want to look here? If consumer spending is wavering, if the Fed is uncertain, are there areas of the market or individual stocks where it sort of doesn't matter as much, or where it's going to be more resistant?
Well, look, we always try to follow the money, right? And if we're doing that, and just look at this week, we had comments from Cisco, from Foxconn about continued strength in AI demand, even CoreWeave, which shares are going to come under pressure today because of the lockup expiration. Their fourth quarter capital spending is expected to jump significantly compared to other quarters this year. So again, follow the money. And what it tells me is that the AI trade, your NVIDIAs, your Marvells, which we own in the portfolio, that trade is still very much intact.
Chris, good to see you. Chris Versace of Thematic Research. Appreciate it.
Thanks.
Coming up on Yahoo Finance Opening Bid, executive editor Brian Sozzi is with us now. Soz, what do you got on tap?
I'm in a stocks mood, Julie. In fact, I'm just in a mood altogether today. So it's going to be a fun show for me and viewers all around the world. Really focused in on this Intel story. I think it's ridiculous that Intel would even entertain potentially taking a stake from the Trump administration. Just mind-blowing stuff. Also locked in on Salesforce. An upgrade out of Gil Loria at D.A. Davidson caught my attention.
Interesting. You present it as though they have a choice.
What, is that Salesforce?
No, Intel.
Yeah, well, look, Intel has about $22 billion in cash, Julie. They have a choice. They don't necessarily need to cut a bailout deal, which this would remind me of what happened during the great financial crisis. But again, Intel's not talking about this, but we're going to talk about it.
Man, I wish I was going to be with you.
You should be.
I'll just have to watch. Thanks, Soz. That does it for Morning Brief. Much more ahead on Yahoo Finance.